You are witnessing something that has never happened before. Not in this way. Not at this speed. Not with these stakes. On January 24th, 2026, as you read these words, silver is trading above $100 per troy ounce. Gold has breached $5,000. Bitcoin sits paralyzed near $90,000. The dollar oscillates, confused. And beneath all of this, beneath the surface chaos that news anchors will try to explain away with talk of tariffs and geopolitics, a structure is collapsing. A 70-year system of price discovery, of trust, of promises written on paper, is breaking down in real time. This is not a rally. This is not speculation. This is a market screaming that the emperor has no clothes and that the vault, when you finally go to check, when you finally demand delivery, is empty. The numbers tell a story that should terrify anyone paying attention. Silver has risen 234% in 1 year. Not 14 months, not 18. 1 year. Gold is up 80%. These are not the movements of assets appreciating. These are the movements of a measuring stick breaking. These are the movements of a currency dying. And the most dangerous signal of all, the one that violates every rule in the traditional playbook, is this. Gold and silver are rising together explosively, while simultaneously every so-called safe haven in the traditional financial system is either stalling or collapsing. This should not be possible. When gold rises, silver usually follows later. When fear drives capital into gold, risk assets fall. When the dollar strengthens, commodities decline. But none of these relationships are holding. All of them are breaking simultaneously. The correlation structure that governed markets for decades has shattered. And when correlations break, when impossible things start happening in unison, it means only one thing. The system itself is the problem. The assets are not moving. The ground beneath them is liquefying. Now we need to talk about what is actually happening in the silver market, because this is where the facade has torn wide open. In January 2026, in major trading hubs across Asia, physical silver changed hands at $130 per ounce. You read that correctly. $130. At the same moment, the COMEX futures exchange in New York, the official price discovery mechanism, quoted silver at $71. This is an 80% premium, an 80% disconnect between paper contracts and physical metal. This has never occurred before in the history of modern precious metals markets. Gold occasionally sees premiums of 5 to 10% during supply crunches. Silver sometimes trades at modest regional premiums in specific circumstances. But an 80% systematic decoupling between paper and physical prices across an entire region of the world? This is not a premium. This is a market bifurcating into two separate realities. One where silver exists and one where it does not. Let that sink in. While Western exchanges were still pretending silver could be had for $70, industrial users in Japan, Dubai, and Shanghai were paying $130 for the privilege of taking possession. They were not buying contracts. They were not accumulating positions on margin. They were paying double to ensure the metal would actually arrive. This tells you everything you need to know about trust, about scarcity, about what happens when the paper market's promises are finally called due. The mechanics of this collapse are staggeringly simple once you see them. For decades, the silver market operated on a gentleman's agreement. Futures exchanges like COMEX and the London Bullion Market Association created contracts, promises to deliver silver at a future date. The volume of these paper promises exploded far beyond the physical metal backing them. At one point, the paper-to-physical ratio reached 356 to 1. For every single ounce of actual silver sitting in a vault, there were 356 paper claims promising ownership. The system held because of one simple assumption. Nobody would ask for delivery all at once. In January 2026, that assumption failed. In one single week, 33.45 million ounces of silver were physically withdrawn from COMEX for delivery. That represented 26% of the exchange's registered inventory. Gone in 7 days. Not rolled forward, not cash settled, withdrawn, removed, taken into private hands. And this was not an isolated event. COMEX registered inventories have declined 70% since 2020, falling from 346 million ounces to just 82 million ounces. The London Bullion Market Association has lost 40% of its holdings. Shanghai inventories have reached decade lows. And then came the number that sent a chill through every institutional desk that understood what it meant. Silver lease rates, the cost to borrow physical metal for short periods, exploded to 8%. In normal markets, lease rates hover around 0.3 to 0.5%. They represent the compensation holders' demand for temporarily lending their metal. When lease rates spike to 8% to 19% to 35%, as they did multiple times in 2025, they are screaming one message. There is no metal available. The cupboard is bare. And if you want me to lend you what little I have, you will pay an extraordinary price for the privilege. This is what a credit crisis looks like in a commodity market. This is what happens when the paper promises, the derivatives, the futures contracts all come crashing into the hard wall of physical reality. The metal does not exist. It never existed. It was promised, traded, leveraged, and rehypothecated hundreds of times over. And now, as the tide goes out, we are seeing who has been swimming naked. But why now? Why is this happening in January 2026? Because on January 1st, 2026, China implemented the most aggressive precious metals export controls since their rare earth restrictions. Beijing reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver over the 2026 to 2027 period. 44, out of hundreds of smaller and mid-sized exporters that have historically supplied global markets. These authorized companies must have annual production capacity of at least 80 tons and verified credit facilities exceeding $30 million. This is not a trade policy. This is a weapon. China controls 60 to 70% of the world's refined silver supply. They exported over 4,000 tons in the first 11 months of 2025 alone. And now, with the stroke of a pen, they have ring-fenced that supply. They have effectively told the rest of the world, you can no longer rely on Chinese silver to plug your deficits. From 2026 forward, you are on your own. Good luck. The timing is not coincidental. The silver market has been running in structural deficit for 5 consecutive years. Between 2021 and 2025, cumulative shortfalls reached 820 million ounces, nearly equivalent to an entire year of global mine production. These deficits were being papered over by drawing down above-ground inventories, by draining exchange warehouses, by moving metal from eligible to registered status, by every accounting trick available to postpone the day of reckoning. China's export restrictions did not create the shortage. They simply removed the last buffer that was hiding it. And the reason those deficits exist is because silver is no longer just a monetary metal. It has become an industrial necessity with no viable substitute. Roughly 60% of annual demand now comes from applications where silver is required, not preferred. Solar panel manufacturing alone consumes massive quantities. Each panel needs silver paste for conductivity. Electric vehicles require significantly more silver than traditional automobiles for electrical systems and battery connectors. Semiconductor manufacturing, 5G infrastructure, artificial intelligence hardware, data centers, all demand silver for its unmatched electrical and thermal conductivity properties. The United States government now classifies silver as a critical mineral for national security. This is not a speculative asset anymore. This is strategic infrastructure. The supply side, meanwhile, faces constraints that cannot be solved by price alone. 75 to 80% of silver production comes as a byproduct of copper, zinc, and lead mining. This means that higher silver prices do not automatically stimulate increased silver output. If base metal economics do not justify opening or expanding a mine, the silver comes along for the ride, or it does not come at all. Primary silver mines comprise only 25 to 28% of global output, and mine production peaked in 2016 at roughly 900 million ounces and has fallen to approximately 820 million ounces in 2025. Ore grades have declined at mature operations. Regulatory challenges have intensified in major producing countries like Mexico. The supply curve is structurally inelastic. Do you see the trap that has been set? Demand rising inexorably from industrial applications that cannot substitute away. Supply constrained by geology, economics, and geopolitics. Inventories draining at unprecedented rates. And overlaying all of this, a paper market built on leverage and promises that is now being stress tested by actual delivery demands. Now compare what is happening across different markets, because this is where the truth reveals itself. In Shanghai, physical silver trades at premiums of 7 to 8% above COMEX futures. In Japan, premiums on secondary market platforms have surged to 60%. In Dubai, premiums sit around 40%. In China, where domestic prices are less transparent but industrial users are desperate, reports suggest premiums even higher. These are not small inefficiencies. These are not temporary dislocations that arbitrage traders will smooth away. These are markets screaming that physical metal is worth far more than what Western paper contracts claim. And it is not just premiums. Look at the structure of the futures curve itself. Silver futures have fallen into sustained backwardation. That means near-term contracts trade at higher prices than deferred contracts. Spot silver is more valuable than silver promised 3 months from now. This is the market's way of saying, I will pay you extra to give me the metal today because I'm not confident it will exist tomorrow. I'm not confident you will be able to deliver when the contract settles. Backwardation is the signature of physical scarcity overwhelming paper promises. This creates an arbitrage that should not persist. If Shanghai physical silver is trading $8 above COMEX futures, traders should buy COMEX contracts, take delivery, ship the metal to Shanghai, and sell it for an instant profit. That arbitrage should compress the premium. But it is not happening. Why? Because COMEX cannot deliver. Because the metal is not there. Because when traders try to stand for delivery, they face delays, cash settlement offers, and quiet suggestions to roll their positions forward. The arbitrage fails not because of shipping costs or logistics. It fails because the Western exchanges have become unreliable counterparties in physical transactions. The London Bullion Market Association provides another data point that should chill you. In 2021, the LBMA admitted it overstated its silver holdings by 3,300 tons. They called it a calculation error. The market called it something else. Trust, once broken, is difficult to restore. By 2025, LBMA eligible silver stocks had shrunk to only about 155 million ounces, while floating annual demand was running at 900 million to 1.2 billion ounces. The math does not work. The metal is not there. And lease rates spiking to 8% are the market's way of expressing that terrifying realization. This brings us to the divergence that nobody is discussing, but that matters more than anything else. Bitcoin. Where is Bitcoin in all of this? Gold has risen 80%. Silver has exploded 234%. These are the classic monetary hedges, the stores of value that investors flee to when faith in fiat currencies cracks. And yet, Bitcoin, the supposed digital gold, the inflation hedge, the censorship-resistant asset, sits paralyzed near $89,000 after peaking at $126,000 in October 2025. It has fallen 28% from its high. It broke below key moving averages. It faced $600 million in liquidations, and it is going nowhere. Why? Because Bitcoin's narrative, the story that drove it to 126,000, has been revealed as just that, a story. When the real crisis hit, when the choice became binary between physical metal you can hold and digital tokens you cannot, the market voted with its money. And the vote was not close. Gold rose 80%, silver rose 234%, Bitcoin fell 28%. This is not an accident. This is not market noise. This is the market teaching you what money is. Bitcoin was never competing with gold. It was competing with dollars, with euros, with digital claims denominated in failing fiat currencies. And as long as those fiat currencies retained some semblance of purchasing power, Bitcoin could present itself as the superior digital alternative. But when the crisis arrives, when you need to settle a trade in physical metal, when industrial users need actual silver to keep factories running, when central banks need tangible reserves, Bitcoin offers nothing. It is a network, a protocol, a brilliant piece of technology, but it is not money in the way that 5,000 years of human history defines money. And the market, in its brutal wisdom, is repricing that distinction in real time. The gold to silver ratio tells another piece of this story. For most of modern history, the ratio has fluctuated between 50 and 80. It measures how many ounces of silver you need to buy 1 ounce of gold. When the ratio spikes above 90 or 100, it signals that silver is dramatically undervalued relative to gold. When it compresses below 50, silver is outperforming. In April 2025, the ratio hit 105. Today, in January 2026, it sits near 57. That represents a compression of 48 points in less than a year. This is silver screaming its way back into relative parity with gold. And if you understand history, you know what this signals. In periods of monetary system stress, in periods when currencies are failing and real assets are repricing, the gold-silver ratio compresses. It happened in the late 1970s when inflation destroyed faith in the dollar. It happened in 1980 when silver briefly traded at a ratio below 20 to 1 with gold. It is happening now. And if this compression continues, if the structural supply deficit persists, if China maintains export controls, if industrial demand keeps rising, the ratio could fall to 40 to 30, even to the historical norm of 15 to 1 that prevailed for centuries when both metals circulated as currency. Do the math. If gold is at $5,000 and the ratio falls to 40, silver should be at $125. If the ratio falls to 30, silver should be at $166. If it falls to 20, silver should be at $250. These are not predictions. These are simply arithmetic progressions based on historical precedent and relative scarcity. And given that silver has already demonstrated it can rise 234% in a single year, given that physical premiums are already touching $130 in parts of Asia, these numbers are not fantasy. They are increasingly probable outcomes of the forces already in motion. This is where the system breaks, because every central bank, every commercial bank, every bullion dealer, every futures exchange, every financial institution that has sold promises they cannot keep is now staring into the abyss. When physical delivery becomes the only benchmark that matters, when paper contracts are rejected by industrial users and investors who want actual metal, the entire pricing mechanism collapses. The futures markets lose their function. The banks that are short face catastrophic losses. The ETFs that promise to hold silver face redemption demands they cannot meet. And unlike previous squeezes, unlike previous shortages, this one cannot be solved by jawboning or by intervention, because the shortage is real. It is not a speculative attack. It is not a coordinated effort by a few large players. It is the cumulative result of 5 years of deficits, decades of underinvestment in mining, exponential growth in industrial applications, and geopolitical decisions by a superpower to secure strategic resources. You cannot print more silver. You cannot create it with monetary policy. You cannot talk the price down when industrial users need the physical metal to keep production lines running. What does this mean for those holding cash? It means you are holding a promise written by institutions whose solvency is increasingly in question. The Federal Reserve is under investigation. Jerome Powell faces a criminal probe. Confidence in central banks as impartial guardians of monetary stability is eroding. And while that confidence erodes, the purchasing power of every dollar, every euro, every yen continues its inexorable decline. Gold at $5,000 is not gold appreciating. It is the dollar depreciating. Silver at $100 is not silver getting more valuable. It is fiat currency getting less valuable. The number on your screen is rising because the measuring stick is shrinking. And here is the cruelest irony of all. Time itself has become the enemy. When you hold cash, you assume you can convert it into real assets at will. You assume liquidity. You assume that the price you see on a screen is the price you can transact at. But what happens when physical silver is trading at $130 in Tokyo and $71 on COMEX? Which price is real? And when you try to buy, when you finally decide to convert paper into metal, how long does it take for settlement? 3 days? 5 days? 2 weeks? And what does the price do in those intervening days when supply is this tight? This is the trap. The system operates on the assumption of instantaneous convertibility. But that assumption only holds when there is abundant supply on the other side of the trade. When supply vanishes, when inventories drain, when physical premiums explode, that assumption breaks. Suddenly, the dollar in your account is not equivalent to a dollar of physical silver. It is a dollar of exposure to a broken pricing mechanism, to delayed settlement, to the risk that between the moment you click buy and the moment metal arrives in your vault, the price has moved another 20% and your order gets canceled because there is no metal to deliver. What we are witnessing is a regime change, a repricing, a recognition that the monetary system built on trust, on promises, on paper claims backed by nothing but the faith in institutions is reaching its natural endpoint. Gold and silver are not rallying because of geopolitics or tariffs or Trump's latest threat or Federal Reserve policy or any of the proximate causes that financial media will breathlessly report. They are rallying because the system underneath all of those stories, the foundation on which modern finance rests, is revealed to be unstable. The final question is not whether this continues. The structural forces are locked in. Industrial demand is not going away. China's export restrictions are not being reversed. Mine supply is not surging. Inventories are not being replenished. The paper market is not regaining trust. The final question is what you do with this information. Do you continue to hold cash and pray that your dollars will retain purchasing power long enough to convert them into real assets at some undefined future date? Or do you accept that the window is closing, that every day you wait is a day that physical premiums widen, that inventories shrink further, that the gap between paper price and physical availability grows larger? You are watching a system fracture. You are watching the moment when the emperor's nakedness can no longer be ignored. You are watching silver, that most volatile and unloved of metals, that byproduct of other mining operations, that industrial input that most investors forgot existed, become the canary in the coal mine for the entire financial structure. And the canary is not just singing, it is screaming. This is the moment they will study in textbooks. This is the inflection point. January 2026, when physical silver traded at $130 while paper contracts quoted $71. When COMEX inventories drained 26% in a single week. When lease rates hit 8%. When China weaponized the supply chain. When the bifurcation became undeniable. When the choice became binary. Hold paper promises from institutions you hope will honor them, or hold the metal itself and watch as the world slowly, then suddenly, realizes what scarcity actually means. Do nothing is itself a decision. And in markets moving this fast, in systems breaking this fundamentally, doing nothing may be the most dangerous position of all. The old rules are dead. The correlations have broken. The ground is liquefying. And silver, dismissed for decades as gold's poor relation, is revealing itself to be the truth teller in a world drowning in lies. You are witnessing this right now, and the clock is not stopping. It is accelerating.